Hey guys, welcome back to my in-depth stock analyzer platform. In this video, we're going to be taking a look at Corn Ferry, a very highly searched stock in the last couple of months because of its incredible earnings reports. Uh, so let's take a deeper dive into this company. So you can see this is COVID, a nice drop here, and then the pump after COVID that all of the stocks had. But then now there's a correction and we could be looking at a nice investment opportunity. So let's analyze the growth of Corn Ferry. So here we are in the growth segment. First of all, let's look at the earnings. So you can see that in the last year, they really reported good earnings. You can see that the earnings doubled or tripled in the last year, over the last 2 years. It went from 114 to 326. The profit margin, of course, increased also, and the revenue actually jumped too. So now let's look at the free cash flow chart, which is not as significant. You can see that the cash flow also doubled, but it's more of a steady growth. Now one thing, so the free cash flow looks pretty steady, although the earnings had a pretty big jump, pretty significant. If we actually go to the free cash flow margin, you can see that it didn't jump that much. Of course, it did go up from 12 to 17, but not as much as the profit margin. You can see that the profit margin went from 6 to 12, and this is definitely not sustainable. So in our valuation, we're going to have to account for the company coming back basically to its standard in 2021. So let's move on to the valuation. So here we are in the valuation, guys. So if we take a look at the left chart here, the green part is revenue and the blue part is market cap. So you can see that the revenue is actually bigger than the market cap, and the earnings is actually pretty big compared to the market cap also. So yeah, let's look at the PE because this one is what we're interested in first. So you can see that the 5-year PE is really steady, and the PE right now is actually pretty low compared to the PEs before, which is expected since their earnings went up so much. PE is price to earnings, which means that it would go down when the earnings go up. So now the enterprise value to earnings chart. Now I love this chart because it basically supports companies with strong balance sheets, and that's why I love it. So enterprise value to earnings. Enterprise value is what you would pay for the company if you would want to buy all the shares plus pay down all of the debt that the company has. And E is earnings. So enterprise value to earnings. This one supports the companies that have low debt, and you can see that Corn Ferry actually has more cash than debt because the enterprise value is lower than the PE. The enterprise value to earnings is lower than the PE. So love to see that. Now the price to free cash flow is very similar to the PE in that it compares the price to the free cash flow instead of the price to earnings. So you can see that the price to free cash flow also went down since the cash flow also doubled in the last 2 years. So the book value chart, I love to see this chart because everything is growing, especially the book value, and they have a lot of current assets, which the percentage of the current assets, I love to see it at least 50%. This is 50% is a really great number for percentages of current assets because current assets are liquid assets such as cash, and they can be used right away. And that's amazing because the long-term assets are a lot worse in that they can't be sold that quickly. So here we are in the financial health, guys. So first we're taking a look at the shares outstanding chart. Now I don't love this chart because the shares went up for the first 5 years and then started to go down. but it's not the best shares outstanding chart. For their assets and liabilities chart, their assets are growing very nicely, and their liabilities are also growing. So not the best, but their book value, which is assets minus liabilities, is improving. So that's good. So then the cash and free cash flow to debt chart, you can see that they really don't have that much debt, and their cash is actually much higher than their debt, always. Um, you can see that in 2020 they had to take some debt because of the pandemic, most likely, and now they're trying to pay it back. But their cash is really increasing, and their free cash flow is also increasing. So with their assets, you can see that they actually do have a lot of current assets, which I love to see. They have a lot of cash and a lot of receivables. Um, And for the long-term assets, we don't care about these as much because it's basically goodwill and intangibles. We can't really do anything with those. And other things like property, plant, and equipment, which can't really be sold, so not as important there. Now for the liabilities, you can see that um, well, they don't have a lot of debt. They don't have a lot of current debt. They have a lot of long-term debt, but that's okay because their cash is way bigger than their debt. So now let's go on to the dividend and other ratios. So here we are in the ratios and dividend. Now, their ROIC and ROA chart is not the best, but it's not also the worst. You can see that their ROIC is very high, which I love to see, especially in the last year, but that's just because they had a high amount of earnings. But the ROA is lacking behind a little bit. It's pretty low. In the last year, it's 10.2, which is completely fine, but 4.10 is not the best ROA. So, not the best with ROA and ROIC. However, they do pay a dividend. It's not the biggest dividend, as you can see, that it's only 1%, but the payout ratio is really low, so I don't mind it. Now moving on to the forecast, you can see that earning and revenue estimates into the future are actually pretty good, especially because especially considering the fact that they jumped up the last years so much. So analysts are expecting it to just grow. You can see that the revenue is going to grow. The earnings are going to fall back, but not too much. This is expected since they had a huge pump here, and the margins are also going to go down, of course. Now, let's go to the summary and intrinsic value calculator. So you can see that at the left side of the page, you can see that their financial health and valuation and growth are really great because this is a really stable and great company. Their balance sheet is amazing. However, ratios and dividend is fine. They don't have the biggest dividend, but the payout ratio is great. Now, the forecast is the only pillar that I'm kind of concerned with, since they did grow a lot in the last year, so nobody really knows where they're going to go from here. I personally think that they're going to experience a huge pullback from this point. But let's value this company. So for the growth, I'm actually going to go with, for the revenue growth, I'm going to go with 0%, 2%, and let's go 4%. And for the profit margin, you can see that in the last year they actually increased their profit margin by quite a huge amount, from 7.3 to 12. But I'm actually going to keep it at 7.3 here, and these other ratios, which are auto-generated. Because we don't want to put in the latest year. We want to actually put in the 5 years, last 5 years, because this most likely isn't a very stable profit margin. So for the free cash flow margin, it's pretty similar. We also don't want to put in this amount because it's not very stable. We want to put in the 5-year amount. So I have that here. It auto-generated these for me already, so that's fine. For the price to earnings, I'm going to go with a little lower for this company since it's not that much of a growth company. Let's go with 11, 12, and 13 for both the price to earnings and the price to free cash flow. And for the discount rate, we'll just keep that as it is. So you can see that the free cash flow is actually, the free cash flow multiple is all in the green and the earnings multiple is all in the red. What does this mean? This means that the company doesn't have as much earnings as it has free cash flow, which means that they could be getting the free cash flow from different sources. They might be selling stuff, selling assets off, and stuff which is not included in the earnings because earnings are just what they get from selling their product. So, personally, I don't think the company is a buy right now. I will wait until it is about 30, I would say. But I do love this company. I think that it has a bright future ahead. I just don't think that the growth level or the earnings level right now is that sustainable. So I will actually add this to my watch list. I will not use the assumptions though. And then, as you can see, I already have it in my watch list, but yes, I do want to replace it. And I'm going to say that my buy price is 35. So you can see that that will put in a Corn Fairy here, and you can see my buy price is 35, aka intrinsic value. So I hope you enjoyed this video, guys. Plenty more are coming. I'm working on this platform. I'm trying to make it a website. So if you do appreciate that and want to get this website, then smash the like button and make sure to subscribe to see all my future content. And as I said, I'm working on the website, so it's going to come very shortly. So I hope you enjoyed, and I'll see you next time.